when the bubble burst. Subsequently, the cotton boom of 1838 to 39 preceded the debt repudiation depression that lasted until 1845. In the antebellum South, cotton was king. As the railways expanded in the South, construction of new textile mills along the rail lines drove an increased demand for raw cotton. In addition, demand for baled cotton continued to remain high in Britain due to its flourishing mill system in Greater Manchester and beyond. However, the Panic of 1837 in America wreaked havoc on the state-based banking system that had gone on a money creation binge. In response, the states implored the U.S. Congress to bail them out as it had in 1789. Congress declined. In turn, many states repudiated their debts to the federal government. A 6-year depression followed. Of more than a dozen significant boom-bust cycles preceding the 1930s, the best known was the bull market boom of 1928 to 29. That preceded the crash of 1929. This resulted in a depression that lingered until the beginning of the Second World War in Europe. Taking office during the first recession that followed World War I, President Warren G. Harding and Vice President Calvin Coolidge pushed Congress for the economic plan called A Return to Normalcy, with a national budget program, tax reductions, emergency protective tariffs, farm bankruptcy relief, and immigration restrictions. As a result, the gross domestic product grew by an average of 7% per annum from 1924 to 1929. High wages and surplus savings created an investment vacuum.
Wall Street responded. The crash of 1929 remains our best lesson of a manipulated financial bubble. During the 1920s, the United States experienced unrivaled prosperity. The businessman was exalted. By March 1928, market speculation had grown into a national pastime. During the following year and a half, market gains exceeded those of the previous 5 years. Unscrupulous manipulation had slithered into the market. Brokers banded together in trading pools to manipulate specific stocks. Over a period of months, pool managers quietly accumulated shares of the target stock. Next, the pools enlisted the help of the stock's specialist, the person who worked on the floor of the exchange and kept a private book of buy-sell orders. Using insider information, the pool members traded with one another, allowing their trades to be recorded on the public stock ticker. Repeating this action again and again produced the illusion of a hot stock, and the members continued to trade the same share back and forth. By increasing market volume and price throughout successive trades, the pools created the impression of speculative activity. As the pools heated up, they enlisted the support of loyal tip sheet writers to fan the flames. Now, these tip sheet writers were the 1920s equivalent of CNN Money and the Bloomberg Channel. Attracted by ticker activity and managed news, millions of non-savvy investors thronged to purchase shares. As the market price reached its apex, the pools sold their inventory of shares to a waiting and willing public, a soon-to-be wiser public. Pool members reaped enormous profits while the public found itself holding stocks that suddenly deflated. The chief financial officers, CFOs, and other insiders were selling stock in their own companies and selling it short. And this means that they were selling shares of their own stock that they had borrowed, expecting to buy them back later at a lower price. In March 1929, Herbert Hoover took office as president. By Labor Day weekend, the financial goose was cooked. The market peaked on September 3rd and subsequently declined sharply on September 9th. The market faltered for the next month and a half, and much like the bobbing stern of the HMS Titanic before it went under, so that by October 21st, gradual price declines wiped out the equity of many investors. In turn, this led to margin calls in which brokers demanded that investors contribute more equity to cover the fall as they went below water on their stock. Most customers either sold low or lost their investment as they failed to meet margin calls. These events led to further market price declines. Finally, on Black Thursday, October 24th, prices plummeted as 13 million shares were traded. During the following weekend, attempts were made to stabilize the markets by both the government and by bankers. However, on Black Tuesday, October 29th, more than 16 million shares were traded as the stock market began its long-term descent. At the end of the year, President Hoover tried to fight the ensuing depression by instituting public work projects, the Smoot-Hawley tariff, and increased corporate taxes. In 1930, there was a short-lived economic recovery, but afterwards the market ratcheted downward through 6 additional episodes of bleak, brief hope before bottoming out in July 1932. After a slight recovery during the election season of 1932, the economy backslid during the winter of 1933 as banks failed and closed. That year, the Great Depression reached its depth. On February 28th, depositors ran on banks, which in turn closed their doors very quickly. And 4 days later, Franklin Delano Roosevelt took office as president. 5 days after that, his administration passed the Emergency Banking Act. Finally, FDR convinced Congress to enact the New Deal program for economic recovery, and later that year the economy began to recover. However, sustained recovery only occurred after the war in Europe commenced in September 1939, as Allied nations demanded armaments and food from U.S. producers.
To understand what continues to happen today, let's look at the more distant past. One of the most famous bubbles in history is the Dutch tulip bulb craze of the early 17th century. The tulip craze reflects simple idiocy coupled with the stupidity of crowd mentality. Though most of us identify tulips with Holland, they were not indigenous to that country. Originally, tulips came to Holland from Turkey in 1593, imported as a luxury good. However,